It is a pleasure to be here today to have the opportunity to speak before you. I was a freshman here at Columbia nearly 40 years ago. I'm certainly glad to be back, but I must admit there is a downside. It does make me feel a bit old in the process. Tonight I want to talk about two broad sets of issues. First, the Federal Reserve's role in responding to the crisis and the steps we must take to reduce as much as possible the risks of this type of costly and painful episode in the future. And second, the economic outlook for 2010 and some of the challenges that the Federal Open Market Committee faces in the conduct of monetary policy. The actions by the Federal Reserve over the past 2.5 years have been critical to stabilizing the financial system and preventing the extraordinary distress in markets from causing a deeper and more protracted economic downturn. Much of the Fed's ability to respond effectively as it did during this crisis, whether it was from a monetary policy, a lender of last resort, or supervisory perspective, came from its breadth and depth of knowledge and experience with financial institutions, financial markets, and financial market infrastructure, both inside and outside of the United States. That said, there's also no question that the Federal Reserve and other regulators could have done more to prevent this crisis. That is why, even as the Fed has engaged in extraordinary efforts to stabilize the financial system over the past couple of years, it has also been moving quickly to make internal changes necessary to strengthen our effectiveness. In addition, the Fed has been working with other regulators inside and outside the United States to craft and implement the broader changes in regulation and supervision that are necessary to make our financial system more robust and resilient going forward. Now, turning to the outlook, the recession now appears to be over, but the economy is still weak and the unemployment rate is much too high. These circumstances underpin the Federal Open Market Committee's commitment to keeping short-term rates low, exceptionally low, for an extended period of time. However, at the same time, it deserves emphasizing that the Federal Reserve will be willing and able to exit from this period smoothly when the time comes to ensure that inflation stays low and inflation expectations well anchored. As always, my opinions tonight represent my own views and not necessarily those of the Federal Open Market Committee or of the Federal Reserve System. Now, with the benefit of hindsight, it's clear that the Fed and other regulators, both here and abroad, did not sufficiently understand some of the critical vulnerabilities in the financial system, including the consequences of inappropriate incentives, the opacity and the large number of self-amplifying mechanisms that were embedded within the system. Likewise, we did not fully appreciate all the ramifications of the growth of the shadow banking system and its linkage back to regulated financial institutions until after the crisis began. Of course, understanding now what we did not understand then is only half the battle. We need to respond to ensure that ongoing changes in our financial system do not threaten the stability of the financial system in the future. For one, the crisis is provoking a reevaluation of our views on how to respond to asset bubbles. For years, central bank orthodoxy has been that you cannot identify asset bubbles very well. Thus, the strategy has been to move aggressively to clean up such bubbles after they have burst. I think our level of confidence in that approach has been considerably reduced in the wake of the crisis that we've just experienced. The fact is, the costs of cleaning up after the fact have been immense. But make no mistake, developing an effective, more proactive approach is not easy. Among the important questions that will need to be answered are: one, how does one identify bubbles, which I'll define here as persistent deviations in asset prices from their fundamental value? How do we do that in real time? And two, what instruments can be used to limit the development of bubbles and or allow bubbles to deflate in non-catastrophic ways that will not damage the economy? Turning to the first issue, identifying asset bubbles in real time is difficult. However, identifying variables that often are associated with asset bubbles, especially credit asset bubbles, may be less daunting. To take one recent example, there was a tremendous increase in financial leverage in the U.S. financial system over the period from 2003 to 2007, particularly in the non-bank financial sector. This sharp rise in leverage was observable. Presumably, this rise in leverage also raised the risk of a financial asset bubble, and the impact of this bubble on housing certainly raised the stakes for the real economy if such a bubble were to burst. This suggests that limiting the overall increase in leverage throughout the system could have reduced the risk of a bubble and the consequences if the bubble were to burst. Now, turning to the second issue of how to limit and or deflate bubbles in an orderly fashion, the fact that increases in leverage are also associated with financial asset bubbles suggests that limiting increases in leverage may help to prevent bubbles from being created in the first place. This again suggests there is a role for supervision and regulation in the bubble prevention process. For example, it might be appropriate for the Federal Reserve, working with functional regulators such as the Securities Exchange Commission, to monitor and limit the buildup in leverage at the major securities firms and the leverage that these firms extend to their clients and counterparties. Now, whether there's a role for monetary policy to limit asset bubbles is a more difficult question. On the one hand, monetary policy is a blunt tool for the use in preventing bubbles because monetary policy actions have other important consequences for real economic activity, employment, and inflation. On the other hand, however, there is evidence that monetary policy does have an impact on desired leverage through its impact on the shape of the yield curve. A tighter monetary policy, by flattening the yield curve, may limit the buildup in leverage. Whether it would be more effective to limit leverage directly by regulatory and supervisory means or via monetary policy is still an open question, but it is becoming increasingly clear that a totally hands-off approach is problematic. I also believe we could have done better in our supervision of large, complex commercial banking organizations. For example, the recent reports issued by the Senior Supervisors Group, which is composed of regulators from 5 major countries, indicated that banking regulators both here and abroad should have been tougher in their assessment of the quality of management, of governance, and in terms of these banks' risk management capabilities. We should have also pushed harder for better management information systems and more simplified corporate organizations and structures. We should have done more to identify best practices in terms of risk management, liquidity, capital, and compensation, and push harder to force the laggards to move to best practice standards. We are learning a lot about how to do supervision better and are working aggressively to apply those lessons to our current practices. The Supervisory Capital Assessment Process, or SCAP, is an important example of the value of broad, horizontal examinations. In the SCAP, the Federal Reserve worked in conjunction with the other U.S. regulators to assess the impact of a stressed economic environment on the 19 largest banking organizations in the country simultaneously. This approach made the SCAP a particularly powerful exercise. It allowed the supervisors to ensure that the collective results of the individual banks were consistent with the top-down assessment of revenue and credit losses generated from an adverse stress scenario for the overall macro economy. We are incorporating these types of broad horizontal reviews more deeply into our supervisory process. So what else are we going to do going forward? Well, there are a large number of initiatives underway to make our financial system more robust to shocks and more resilient to the inevitable swings in activity and sentiment. These initiatives include several aimed at strengthening bank capital requirements. When these initiatives are fully implemented, they should prevent some of the practices we witnessed during the crisis. For example, a banking organization paying out dividends to demonstrate that it is strong, when in fact, by depleting capital, such an action is making it weaker. One important initiative in this regard is to better capture all the risks in the capital assessment process. This, for example, includes the trading accounts of banks. Some institutions had clearly not set aside adequate levels of capital given the risks that were embedded in their trading positions. We are also exploring the potential for contingent capital. The goal is to bolster the amount of common equity available to absorb losses in adverse economic environments. This might be done by allowing the issuance of debt instruments that would automatically convert into common equity in stressed environments under certain pre-specified conditions. Such instruments might have proven very helpful had they been in place before and during the crisis. Investors would have anticipated that common equity would be replenished automatically if a firm came under stress, and this knowledge might have in turn tempered anxieties about counterparty risk. At a minimum, contingent capital instruments might have enabled common equity buffers at the weaker firms to be replenished earlier and automatically, thereby reducing uncertainty and the risk of failure. Now, there are many details that need to be worked out to determine the potential for contingent capital instruments in terms of their ability to enhance financial stability. For example, what are the circumstances under which conversion would be triggered? How much common equity do the debt holders receive upon conversion? However, our early work on this issue suggests that contingent capital may be a promising mechanism for injecting common equity into the banking system in times of stress without unduly raising intermediation costs or pushing financial activity out of the banking sector into the unregulated sector. On the liquidity front, there are a host of initiatives underway. For starters, the Federal Reserve is now supervising most of the holding companies of the systemically important financial institutions. That was not true at the start of the crisis. So, for example, the holding companies of Goldman Sachs, Morgan Stanley, and Merrill Lynch, which is now a subsidiary of Bank of America, are now under our direct supervision. We are making sure they have appropriate liquidity buffers and capital. Second, the Fed is working with a broad range of private sector participants, including dealers, clearing banks, and tri-party repo investors, to dramatically reduce the structural instability of certain financial system utilities, such as the tri-party repo system. Third, the Basel Committee is working on establishing international standards for liquidity. There are two parts to this. The first is to require a short-term liquidity buffer of sufficient size so that an institution that was shut out of the market for several weeks would still have sufficient liquidity to continue its operations unimpaired. The second is a liquidity standard that would limit the degree of permissible maturity transformation, that is, the amount of short-term borrowing that would be allowed to fund long-term illiquid assets. Under these standards, a firm's holdings of illiquid long-term assets would need to be funded mainly by equity and long-term debt. There's also work underway on the problem of how to ensure that financial institutions have compensation structures that curb rather than encourage excessive risk-taking. This issue of compensation is obviously a hugely potent one, as there is a fundamental unfairness in what has happened over the past few years. The actions taken by the Federal Reserve and others to stabilize the financial system had the effect of rescuing many of the same financial institutions that contributed to the crisis. Many of those financial institutions are now prospering, and many of their employees will be highly compensated. This situation is unfair on its face. But it is even more galling in an environment in which the unemployment rate is 10% and many people are struggling to make ends meet. Despite the fundamental unfairness of the situation, I don't think it's feasible or practical for the Federal Reserve or any other supervisory entity to attempt to determine the level of compensation at individual firms on an ongoing basis. A better approach is for supervisors to ensure that a firm's compensation regime is consistent with an institution's safety and soundness and with broader financial stability. That could and should have important implications for the level of individual compensation, however. For example, a trader should not be paid solely on the basis of this year's accounting profits if those profits are based on the valuation of illiquid assets held on the bank's books that could easily go down considerably in value before they are liquidated. The Fed is in the process of implementing a framework that will embed compensation practices more deeply into the supervisory process. And we've made it clear to the major banks and dealers that 2009 compensation should be consistent with the recently developed Financial Stability Board principles on compensation, which emphasize the importance of appropriate incentives. Finally, there's considerable work underway on the, quote, too big to fail problem, unquote. On this front, there are two major strands of work. First, we must improve the resolution mechanisms for large, complex bank holding companies and non-bank financial firms that become troubled. and complement that initiative with efforts to strengthen the financial market infrastructure. If regulators had at their disposal an effective resolution mechanism for large financial firms and the financial system was made more resilient to shocks, then the number of firms that were indeed too big to fail could be significantly reduced. Second, after building such a resolution mechanism, we must still act to ensure that no special advantage persists from being perceived by creditors, counterparties, or investors that a firm is too big to fail. After all, it will be hard to build a resolution mechanism that credibly ensures that any firm will be allowed to fail under any circumstance. If there is a chance that a firm may be too big to fail, then there should be an explicit quid pro quo for that status in the form of higher capital and liquidity requirements. For example, contingent capital could be made part of any additional regulatory capital requirements for firms that might be too big to fail. As I've discussed, we're moving forcefully to make the system more robust and resilient. While at times the criticism of the Federal Reserve and other regulators has been on target, at other times I believe it has been off the mark. For example, the Federal Reserve has been singled out for criticism about the failures of supervision, even though it did not have any regulatory responsibility for many of the largest U.S. financial firms that collapsed during the crisis. American International Group, or AIG, is an important case in point. The Federal Reserve learned about the significant liquidity problems AIG was experiencing only shortly before the Lehman bankruptcy. At that time, the Federal Reserve was reassured that a private sector consortium was being assembled to provide AIG with liquidity support if that proved to be necessary. Unfortunately, once Lehman filed its Chapter 11 petition on September 15th, the environment worsened and the lending consortium fell apart. A recent report by the Special Inspector General for the Troubled Asset Release Program, or SIGTARP, suggested that the Federal Reserve should have had a contingency plan in place for AIG. The reality is that, in fact, the Federal Reserve was the contingency plan. Once the private sector backed away from AIG, the Fed, with the full support of the Treasury, was called upon to do something extraordinary and lend to AIG. The Federal Reserve had no authority over this institution whatsoever, but it stepped into the breach and lent to AIG to prevent a catastrophic collapse of the financial system and to protect the public from the fallout that would have resulted from such a collapse. There's also been a lot of criticism in the recent SIGTARP report and elsewhere that the Federal Reserve should have forced AIG's major counterparties to take haircuts in conjunction with the formation of Maiden Lane 3. That's a facility run by the Federal Reserve. The reason for the Fed's actions in this situation are straightforward. From the moment the U.S. government made it clear that its goals was to prevent AIG's bankruptcy in order to stem a broader collapse of the financial system, this undercut the ability to obtain concession from AIG's counterparties. To put it starkly, power in a negotiation comes either from being able to issue a credible threat or from coercion. Bankruptcy at that point for AIG was simply not credible in the context of the actions that had been taken to rescue the firm in the first place. And threatening bankruptcy would have been at cross purposes to the broader goal of stabilizing the financial system. And using our supervisory power in a coercive manner would have been an abuse of that supervisory power. I have highlighted this example because it provides a stark illustration of two critical shortcomings in our current regulatory system. The first is the fact that a large systemically important institution like AIG was able to slip through the cracks in our regulatory structure and put our entire system at risk. The second is the lack of an effective resolution regime for large bank holding companies and non-bank financial institutions. Absent such a regime, a commitment to support a failing firm inevitably results in the loss of leverage in negotiating with counterparties and creditors. Turning now to another difficult issue, it is deeply offensive to Americans, including me, and runs counter to the basic notions of justice and fairness that some of the very same individuals and financial firms that precipitated this crisis have also benefited so directly from the response to the crisis. This has occurred at the same time that many Americans have lost their jobs and hard-earned savings. The public outrage this situation has produced is understandable. In the context of actions taken to support the financial system, the Federal Reserve and other government agencies have provided considerable support to banking organizations and large systemically important financial institutions. The employees and executives of those institutions have benefited from our intervention. In a perfect world, we would have been able to prevent those individuals and institutions from benefiting. We would have had a better way to penalize those who acted recklessly. But once the crisis was underway, one goal took precedence: keeping the financial system from collapsing in order to prevent the nation from an even deeper and more protracted downturn than what we actually experienced. The Great Depression represents an important example of the consequences of inaction. Recall that during the Great Depression, the unemployment rate climbed to 24%. It's generally accepted that the authorities at the time, by not responding sooner and more aggressively, contributed greatly to the severity and duration of the Great Depression. In contrast, during this crisis, the Fed and other agencies acted much more aggressively to ward off a total collapse of our financial system. Liquidity was restored to markets, and the banking system was recapitalized much more quickly. These aggressive actions helped to prevent the type of deep and protracted crisis that occurred during the 1930s. Going forward, the Federal Reserve and other regulators need to move aggressively to change the system so we don't ever find ourselves in this position again. We need to improve our ability to identify the catalysts for potential crisis, whether these catalysts manifest themselves in the form of asset price bubbles or reside elsewhere. Perhaps most critical among the challenges facing policymakers and lawmakers is how to ensure that we have a more effective regulatory structure going forward. This is a complex subject that I do not have time to do justice to tonight. However, I believe it's important to explain why the Federal Reserve's monetary policy, lender of last resort, and supervisory functions should remain in place. These functions are interrelated, so that the execution of one of these responsibilities helps the Federal Reserve in its conduct of the others. For example, consider the Fed's lender of last resort function. For the Fed to perform this role effectively, it is important that it have firsthand knowledge about banks, the capital markets, and the payment and settlement systems. Perform this role safely, it must know its borrowers, which is why a supervisory role is essential. Put simply, if supervisory and other financial oversight responsibilities were taken from the Fed, would make it much more difficult for us to perform our lender of last resort function safely. To do that well and safely, it's important that we understand banks, the financial system, and all its interconnections. One instructive example in this context is the Northern Rock experience in the United Kingdom, in which the banking supervision and the lender of last resort functions were separated. Many have concluded that this separation led to coordination problems that delayed intervention, which significantly exacerbated the crisis. The experience with Northern Rock is a cautionary lesson about the potential costs of separating banking oversight from the lender of last resort function. A similar argument applies to monetary policy. In the conduct of monetary policy, it's important to understand how changes in the federal funds rate or on the interest rate on excess reserve affect financial conditions. A detailed understanding of banks, capital markets, and the payment and settlement systems is essential to properly understand the linkage between monetary policy, the financial system, and the real economy. In other words, if you take away the Fed's oversight of the financial system, the ability of Fed policymakers to understand how their actions are going to affect financial conditions and the economy will be impaired, and the economy will suffer as a consequences. Shifting gears, let me talk a little bit about the economic outlook. My views about the outlook have not changed much recently and do not differ much from the consensus. The situation is slowly improving. We are having a recovery in terms of output, and the paces of job losses has slowed substantially. In the second half of this year, it looks like real GDP growth will average about 3 to 3.5% at an annualized rate. 2010, however, will probably be slightly weaker than that, mostly because some of the current sources of strength that are supporting activity are temporary. The inventory cycle is providing lots of support right now, and the fiscal stimulus, which is very powerful right now, will abate as we go through 2010. 2010 is also likely to be a more moderate growth period because we still face quite a few headwinds generated by the hangover of the financial crisis. The banks are still under pressure in terms of credit losses. The shadow banking system is still impaired, and securitization activity is recovering only very slowly. For example, last month we saw the first commercial mortgage-backed securities deal in a year and a half. This means that the constraints on credit availability will take considerably more time to fully abate. If growth is subdued, this implies that the unemployment rate will stay too high and inflation will stay low. If this outlook is broadly correct, this suggests that it will be appropriate to keep the federal funds rate target exceptionally low for an extended period of time. One risk in the outlook is that inflation expectations could become less well anchored. This could conceivably occur for several reasons. First, people may worry about the expansion of the Federal Reserve's balance sheet and that the increase in the federal debt could prove inflationary over time. Second, some may worry that Congress could take actions that would call into question the Fed's independence with respect to the conduct of monetary policy, and that this could cause the Fed to be less willing to tighten monetary policy in a timely way in the future. A rise in long-term inflation expectations above levels consistent with price stability would be a very unwelcome development because inflation expectations are an important determinant of actual inflation. In principle, if inflation expectations rose, this could push actual inflation up despite the very high unemployment rate. Obviously, this would make it more difficult for the Federal Reserve to use monetary policy to achieve its dual objective of full employment and price stability. On the issue of the size of the Fed's balance sheet, the worry among some is that the rapid growth of the Fed's balance sheet over the past year will ultimately lead to an inflation problem. This anxiety stems from the fact that periods of rapid growth of the monetary base is currency plus bank reserves. In the past, rapid growth of the monetary base have typically been followed by rapid credit growth and inflation. While I understand the concerns, I do not believe they are well-founded. And that's because we have a new tool, the ability to pay interest on excess reserves. And the ability to use that tool should enable us to cut the link between the size of our balance sheet and credit creation and inflation. If we raise the interest rate on excess reserves, we can incentivize banks to hold the excess reserves with us rather than lend them out. And that should work because the price of credit is an important determinant of credit demand. If the Federal Open Market Committee were to raise the interest rate paid on excess reserves, this would raise the price of credit. That in turn would limit the demand for credit. As a result, the excess reserves wouldn't be lent out. Instead, the excess reserves would stay parked at the Fed. That said, the Fed's exit from its current monetary policy stance is going to be more complicated than normal. Normally, when we exit, we simply decide when we are going to raise the federal funds rate target. This time, we have a broader set of decisions to make. For example, do we decide to drain reserves from the banking system? Is it better for the banking system to operate with $500 billion of excess reserves or $1 trillion? This is an issue we have to explore further. In the meantime, we are testing our ability to drain reserves through the use of reverse repurchase agreements. It's important that this option be available to us in the event we want to use it. Although it's going to be more complicated in the sense that we have more decisions to make about how to manage our exit, I believe the process is manageable. The fact that we have more levers to pull doesn't mean that we will have trouble exiting when the time comes. It just means that we'll have more choices to make. Turning next to the issue of the Federal Reserve's monetary policy independence, I believe this is a critical issue. As you may know, the Paul Amendment, which was inserted into the House Financial Services Bill, would subject the Federal Reserve's monetary policy decisions to audit or review by the General Accountability Office, or GAO. We should think about how market participants will react to the potential politicalization of the monetary policy process. Knowing that a decision to raise interest rates today might be criticized by the GAO 6 months later, market participants could begin to worry about the Fed's willingness to make tough decisions in terms of tightening monetary policy. If that were the case, inflation expectations could become less well anchored. This in turn would make it more difficult to keep inflation under control, even if the fears of market participants about the Fed ultimately turned out to be unwarranted. Our monetary policy decisions are already public, and a wide range of Federal Reserve officials, including me, explain the rationale for our actions frequently. It's been well established around the world that monetary policy independence leads to better outcomes in terms of unemployment and inflation. As a result, in my view, any legislation that would cast doubts about the Fed's independence in the conduct of monetary policy would not be beneficial to this country. Thank you very much for your kind attention. I would be very happy to take a few questions.
That was a really excellent speech. President Dudley has covered a tremendous amount of ground in a very short period of time. I may have to cancel the rest of my fall class, given that absolutely everything that I wanted to talk about has been covered in 25 minutes. He has very graciously agreed to take some questions from the audience now, and so I wanted to explain what the ground rules are going to be for that. First of all, there are 2 microphones here in the 2 aisles, so people who would like to present a question to President Dudley should go to one of those microphones to ask your question. Secondly, I would like to ask the questioners to begin by saying your name and your affiliation, just so he can know who you are before you present your question. And thirdly, since we don't have too much time, I'd like to remind the questioners that you should just ask a question and give President Dudley a chance to answer, rather than using the microphone to give your own speech about the Fed. And with that, maybe we can start with the woman here at the microphone on the right.
Hi, my name's Andrea. I'm a senior in the college, and I'm doing an anthropology thesis on foreclosures and unemployment. So I'd like to ask you a question regarding what the Fed is planning to do about unemployment and the related foreclosures that are a result of that.
The level of the unemployment rate, and that's why the Fed has gone to extraordinary lengths in easing monetary policy. The federal funds rate is in the range of 0 to 25 basis points, so we pushed as hard as we can on the short-term interest rate lever. In addition to that, the Federal Reserve is engaged in a number of other actions to further ease financial conditions. One of the most notable one is our large-scale asset purchase program, in which we bought treasuries, agency debt, and agency mortgage-backed securities. And that's been helpful in especially in pushing down mortgage rates and made housing more affordable. The spread between agency mortgage-backed securities and treasuries is unusually low right now, and that's made housing more affordable. And so that's one thing that we've been doing to try to help support the housing sector and prevent some of the foreclosures.
Can we take someone from the microphone over here?
Yeah, thank you. My name is Van Gutfeld. I'm a IBM retiree and an adjunct senior research scientist here. Therefore, I know nothing about economics. But I was wondering if the Fed is aware of the most incredible instruments that the various banks have concocted, which have caused this disaster. I mean, there's insurance on insurance that gets bought by others, and then everything collapses. To me, it makes a Ponzi scheme look like a picnic. What is your opinion on that?
Well, I think your question, I think, is very apt. I mean, one of the problems in the crisis was there was financial engineering that sort of ran amok, and probably the best example of that were collateralized debt obligations, CDOs, and their offspring, which were CDO squares, which were CDOs of CDOs. And the problem with those obligations were twofold. One, they were incredibly opaque, and so the tremendous difficulty valuing what they're really worth, because they're composed of a lot of assets, and then it takes the cash flow from those assets, and then there's a waterfall that determines who gets paid off when. I remember during the early days of the crisis, I was talking to one securities dealer, and they told me a story about one CDO that they were given, and they were asked to price it, and they were told that, they could have a price back to the investor in 2 or 3 weeks. So you can see how that contributes to the crisis, because if you don't know what something's worth, it just contributes to uncertainty and people pulling back. The second big problem in terms of the collateralized debt obligation market was the theory behind collateralized debt obligations did not work very well in practice. The theory of collateralized debt obligations is that you're relying on the fact that all these different assets within the CDO are not perfectly correlated in terms of their performance. But what we saw is when you enter a financial crisis, correlations go up towards 1. And so the diversification benefits embedded in the CDOs turned out to be mostly a phantom. And so the CDOs at the top of the capital structure, the AAA CDOs, which are getting the cash flows from, for example, low-quality subprime mortgages, that works fine if 10% of the subprime mortgages don't perform. But if all the subprime mortgages don't perform, that AAA CDO isn't going to perform very well. So the theory of the CDOs also turned out to be very suspect. So what I think it tells you that we have to do is, one, we need more transparency. And we need more simplified financial asset products. We need more transparency into what those products are, what the prices of those products are. And we also need better modeling. The credit rating agencies that rated these CDO obligations, their models turned out to be very incorrect in a large number of cases.
Hi, Mr. Dudley. My name's Dustin Reed. I'm an American history graduate student at NYU. I have to say, in my studies, macroeconomics, I'm not sure that's the best thing for our economy, but I have some civil questions for you anyhow. And by the way, as far as raising interest rates, can I lobby to you, please raise interest rates? I think they've been low long enough. However, as far as the market setting interest rates, what's your best argument against that happening? And do you think if the market did regulate the interest rates, perhaps it would prevent some misallocation of capital in the private sector?
Well, I don't think that's possible in our monetary policy framework. We live in a fiat money system, so you need a government entity that determines how much money there exists.
Do you think delinking from gold in 1971 was not the wisest decision then?
Well, I would say that we delinked from gold in the 1930s. The 1971 was sort of symbolic more than functional in terms of its impact on the U.S. economy. I think that the fiat money system works well as long as you have a central bank that has the independence to conduct monetary policy, and if the Federal Reserve, in the case of the United States, has that independence of monetary policy, a fiat money system can work very well. If you look at the Federal Reserve since the early 1980s, the Federal Reserve has done a very good job of keeping inflation in check. So clearly our fiat money system has not led to a chronic inflation problem. Those who advocate going back to a gold standard are advocating that in large part because they think that this fiat money system will result in inflation. And I don't think that we've seen that to be the case.
Take another question from over here.
Thank you, Mr. Dudley. Getting over a cold, so bear with me. My name is Eric Sanders. I'm a playwright. My girlfriend works here. Quick question. You, at the beginning of your speech, you used the term fundamental value, and I'm curious what you meant by that.
Well, fundamental value is we don't really know what fundamental value is of just about anything, but you can observe historically where asset prices tend to trade, say stock prices relative to interest rates. And then you can get an idea based on a variety of variables. What range you would view as sort of normal, and that range could be quite wide. But I'll give you an example. The Nasdaq in 2000, when it hit 5,000, that was well outside any normal range, and so that would be an example of asset prices getting probably quite a bit away from fundamental value. And I think, obviously, with the benefit of hindsight, we certainly know now that that was a bubble. But there were a lot of people at the time who thought that was a bubble in real time. So that would be an example of a good example of a big disparity between fundamental value and actual asset price.
Take a question from over here.
Yes, thank you, Mr. Dudley. My name is Mike, and I'm a taxpayer.
Me too.
Congratulations. My question, you spoke about the Fed's inability to extract concessions from AIG's counterparties. Wouldn't it have been possible to use moral suasion in those negotiations to extract concessions and have the counterparties bear certain costs that were instead shifted to the taxpayer is one question. And also, didn't many of the same counterparties have applications pending with the Fed to gain access to the discount window, and couldn't that have been used as a bargaining chip to extract concessions?
Well, as I said in my prepared remarks, we don't think using our supervisory powers to extract concessions is an appropriate use of those supervisory powers. As I said in my speech, the government was trying to prevent the bankruptcy of AIG, and that desire to prevent the bankruptcy of AIG was what fundamentally undermined our bargaining position. And I think that's really why it was, we went to, I think there was, I can't remember the exact number of counterparties, but there was quite a few. And only one counterparty, and this is in the SIGTOP report, was even willing to consider concessions. The concessions were very small, and those concessions would only be granted to the Fed if every other counterparty agreed. Now, it turned out that none of the other counterparties agreed to any concession, and in fact, the French government said that their counterparties were not allowed by law to make concessions. So I think it just wasn't feasible for us to seek those, obtain those concessions. Although I agree, on a fairness grounds, I can see why people could see why those would have been better if somehow those concessions could have been forthcoming.
Is it too late?
It's probably too late.
From over here.
Hi, my name is Caesar. I'm a student in the journalism school, and I actually have a follow-up on the same topic. In March, Goldman Sachs held a conference call with business journalists to explain to them that had AIG not paid it the money that it owed it, it would make no difference to Goldman because Goldman had either swapped out its exposure to AIG or it could buy further hedges to cover itself. If that's the case, if it really didn't make a difference to them whether they got paid through AIG or someone else paid them the money, why did the Fed have just so little leverage and couldn't say, hey, taxpayers are also suffering, you need to take a haircut?
Well, the important point here is if you're preventing a bankruptcy, you're supporting all the counterparties. You cannot pick and choose. And so whether Goldman Sachs was well hedged or not, that was sort of immaterial.
Thank you.
From over here.
My name is Mark Richardson. I'm a graduate student at the School of International and Public Affairs at Columbia. You referenced AIG and the fact that the Fed was being blamed when the Fed had no oversight prior to that. I know it seems to be a common thing in the press, and if you look at the Treasury's blueprint for regulatory reform, they mention things like systemic risk regulator, obviously. I think talk about a federal regulator for insurance companies, because now that's done at the state level, so there are holes there. You have state mortgage originators that are subject to little oversight that, again, are outside the federal umbrella. And it seemed to me that report had many good ideas, but now, as you again mentioned in your speech, the momentum seems to be moving to, in my opinion, and you seem to agree with the counterproductive ideas. So I wonder, what ideas do you think are essential to improve regulatory reform, or to have regulatory reform, and also what do you think is feasible at this point, given the way public opinion seems to be moving?
Well, that's a really big question. I mean, I could give another lecture. I think you made a very strong case for why there needs to be a systemic risk regulator. I think that during the crisis, lots of things fell between the cracks. AIG was a good case in point. There was this very small operation in AIG called AIG Financial Products that was providing insurance on CDOs and other obligations that was, virtually unregulated. And AIG was trading off its AAA rating to run this business with very little capital and collateral in place, and that created a huge vulnerability to the system. I'd like to think that if there had been a systemic risk regulator in place that had the authority to ferret out and prevent these kind of practices, that aspect of the crisis could have been prevented. And so I'm definitely in favor of a systemic risk regulator to do really two things. One, to try to make sure that we can understand our financial system better and make sure that it's more stable so that we build in mechanisms in the financial system that dampen shocks rather than amplify shocks, and also a systemic risk regulator that can intervene in a more timely way to prevent unsafe and unsound practices.
From over here.
Yes. Mr. Dudley, thank you. I'm a junior undergraduate econ major, and I just have a small question. I'm going to ask you to sort of deviate from the sort of micro role at the New York Fed. With the stimulus package here, I feel that it almost constitutes a moral hazard in a sense, especially given America's addiction to credit in the last 10 years, really. And given how we're going to have to address a lot of these global imbalances where we have high savers in Asia, and a negative savings rate in the United States, do you feel that the stimulus package actually hinders that transfer, that we are instead prolonging and sort of killing ourselves? I don't remember who I'm paraphrasing, but by 1,000 cuts almost. And that in a sense, a lot of this, though it relieves a lot of the short-term pain, it doesn't provide for a feasible solution.
Well, I think, in answer to your question, there's a short run and there's the long run. In the short run, the economy is under a lot of downward pressure, and so we need to provide a lot of support to the economy to manage the economy so the unemployment rate doesn't rise even higher. In the long run, I think you definitely want to have the adjustments of what you're implying. Over the longer run, when the economy starts to return to health, we would like to see a little bit less consumption, a little bit more investment in the U.S., a little bit higher savings rate. And conversely, in Asia, we'd like to see a little bit lower savings rate, a little bit more consumption. So there needs to be a rebalancing between activity in the U.S. and the activity in Asia. But that's a long-run workout, not a short-term workout. So I think you really have to distinguish between the near term, where we are right now, trying to support the economy, preventing a Great Depression, with the medium and longer term, where I think we do want to have these a rebalancing of global economic activity.
From over here.
Good evening, Mr. Dudley. My name is Mattia Landoni. I'm a PhD student at the business school. I don't know if I will ever be a taxpayer. So my question is motivated by pure...
Well, I hope so, for your sake.
Pure economic interest. I like the way you explain the game theory problems of bailing out big institutions. And I heard people say not saving Lehman was a good thing because it sets the right precedent. It may be you next time, moral hazard, etc., etc. I've heard people saying it was a bad idea not to save Lehman because now we know how bad it is when you don't save Lehman. So it's even less credible than before. That next time we're not going to save a debtor. What's your opinion on this? Was it a good idea or a bad idea?
Well, I think I would say it's almost irrelevant whether we think it's a good idea or a bad idea. We couldn't save Lehman because there was no buyer. There was not adequate collateral to finance, so there was no way to rescue Lehman because there was nobody who wanted to, take Lehman over. So the Lehman saving Lehman was not really an option. Obviously, the regulators and the private sector looked for a solution to Lehman, and a number of people came forward as potential buyers, but at the end of the day, there was no buyer for Lehman. And I think that's fundamentally the reason why Lehman Brothers failed.
From over here.
Hi, I'm Rich. I'm a graduate of the business school. I think by all accounts, the Fed is losing the PR battle, where there's just a popular outrage, really that's unprecedented. A great example is the giant vampire squid article in Rolling Stone. The question for you is that the responsibility of the Fed? And do you think that's a big failure of the Fed to justify its actions? And it's something that the Fed should be more careful about to really justify what happened and to try to reduce the outrage?
Well, I think that we need to explain ourselves, and that's what I was hopefully trying to do this evening. I do understand the reason for the outrage. I really do. I mean, it is unfair. It is unfair that banks have been saved, and the bankers that go with them have been saved, and some of those bankers are going to receive large compensation this year. And that's particularly unfair in an environment where, the unemployment rate's 10%. If there was some way that we had the tools to save the financial system and not save the bankers, that would have been a better way to go, I think. But we didn't have that choice. The choice that faced us was either financial Armageddon or saving the financial system. And we decided that saving the financial system was the better choice. But I completely understand why people are upset. And I think I would say they don't fully appreciate. It was a choice between two bads, and we picked the bad that we thought was the less bad. But it wasn't a great outcome. We agree with that.
From over here.
Thank you, President Dudley. My name is Eric Beckman. I'm a senior in economics with the School of General Studies. My question is, taking into consideration the shadow banking system, you spoke earlier of the bubble that they have created that has since burst, and also the kind of kitschy but misleading idea of financial innovation that the shadow banking uses to aggregate these massive amounts of wealth. Doesn't that ultimately undermine any type of regulatory body and even the Fed as far as their ability to manage this systemic risk?
Well, I think the growth of the shadow banking system obviously needs to have someone doing some oversight, and that's a primary argument why you want a systemic risk regulator, so that they can be aware of some of the vulnerabilities that maybe rest outside of the institutions that are subject to more formal and in-depth regulation. The SIVs, the conduits, the securities lending operations. There are a whole bunch of vulnerabilities that rest just outside the banking system that did contribute to the crisis. Now, in terms of what caused the crisis, there's not one thing. It was a whole series of things. But there definitely was a vulnerability in the shadow banking system, and that vulnerability was about maturity transformation, that these entities were borrowing short-term and using that short-term borrowing to finance illiquid long-term assets. That worked fine as long as investors were willing to have faith in them. But when that faith evaporated and investors started to pull back, the shadow banking system ran into a horrible liquidity crisis. That led to financial asset sales, which led to lower financial asset valuations. That led to a rise in haircuts on collateral. And so that started the whole downturn in terms of self-amplifying dynamics. And that's the reason why we need to have a systemic risk regulator, and not just have a systemic risk regulator, but have an effective one.
Thank you.
Unfortunately, at this point, I think we have to let President Dudley go on to his next obligation. I see there are a lot of people still with questions. I think that's a sign of how much interest there has been here in his remarks tonight. I'd really like to thank you for giving us this very frank and stimulating discussion, and I hope we can get you back soon. There are clearly a lot more questions for the next visit. Thanks.
Thank you very much.